Hello. Today I wanted to go over the second part of the credit section called credit scores. A credit score is a numerical value that represents your credit risk. This essentially tells lenders how likely you are to repay debts. The higher the score, the safer you come off to lenders, and a lower score will be perceived with more risk. Insurers and employers check your credit score to ensure that you are reliable and responsible, and to ensure that you are not too risky to insure. Thus, a credit score can not only impact the amount of interest you pay on loans, but can also help others determine if you are a trustworthy person to do business with in other aspects of your life. An example of this is how a person might be denied of a job or a promotion because their employer can review their credit score and use what they see to determine whether or not they believe you are fit to get a promotion. And usually, a lower credit score can lead to this. I wanted to start off by providing an example of how a higher credit score can save you money. So let's say you take out a $25,000 loan for a $25,000 60-month loan for a car. If we look at the graph, we see how a higher credit leads to a lower interest rate, which creates a lower monthly payment, and you pay less money in interest throughout the in total. In summary, a good credit score makes taking out a loan more affordable and cheaper. Now imagine how much money you'd save on a $500,000 mortgage for a home with a good credit as opposed to a bad one. I wanted to go over what a FICO score is and the FICO score ranges and what they mean. So, starting off, what is the FICO score? FICO scores are an industry standard for credit scores and they are used by 90% of top lenders. Thus, when applying for loans, the lender will likely check your FICO score. Like other credit scores, a good FICO score indicates to lenders that you are a responsible person who will pay the loan back on time. It also leads to lower interest rates on loans, favorable loan terms, better approval rates, and better credit card rewards. A FICO score is a type of credit score and one of the most widely used credit scores. Thus, knowing what it is and what your number is essential to building a good FICO score. I will go over what it means to be at each of these ranges, starting off with the range of 800 to 850. This is the best spot to be in, as you will qualify for the best rates, loan terms, and credit products. The range of 740 to 799 is a strong position as well to be in, and you will likely be accepted by most loan companies and credit cards at favorable rates. The 670 to 739 range tells lenders you can make timely payments. You will most likely be accepted for most loans, but not at the best rates. It is recommended that you continue to improve your score for a better rate at this range. The 580 to 669 range, in this range, you will be considered a subprime borrower. You may be rejected from loans and credit cards, and if you are accepted, it will likely be at unfavorable rates. The 300 to 579 range is a bad credit range. It tells lenders you are a risky borrower and it will be challenging to get approved for a loan. However, it is possible to rebuild your credit and move up from here. That being said, this wraps up the end of part 2 of credit. So thank you for listening.